Well, we have to keep in mind three particular points here. One is the technical stocks overall have been doing poorly. A, of course, because of the concern about another technical bubble, and B, because some of the earnings, or at least the earnings expectations, have been poor. In the case of Alibaba, although there are international connections, in other words, it has outside shareholders, we have to keep in mind that this is a primarily, if not overwhelmingly, a Chinese tech internet company. And of course, the Chinese equity market, although the Alibaba is being done outside, it's being done in New York, the Chinese equity market has been extremely poor, one of the worst performers in Asia, with more than 5 to 6% year to date down. Also, of course, there is always the question about the pricing of the IPO, and this links back to the concerns over a potential bubble. So I would approach an IPO of a tech stock cautiously, even if that reflects the potential strength of the large internet market in China, in the context always that the Chinese shares so far have been doing badly. Well, my answer has got two parts. I will never tire repeating the Chinese economy is not, NOT, is not export driven. And looking at simply export numbers is completely incorrect. We have to look also at import numbers. If import numbers fall faster than export numbers, then effectively this is a boost to the economy. Also, we have to keep in mind that the net exports, that's what matters, not just the export number. The net exports on average add less than 10 basis points to 100 basis points growth in China. So the impact of that is important, of course, on regions, is important on individual companies, but it's not necessarily important for the Chinese economy itself. So yes, I would be concerned if the net exports decline. I will be totally unconcerned if the net exports actually increase, because that will be a boost to GDP growth, even if both imports and exports fall. I know it sounds completely crazy, but that's basic macroeconomics. Well, macroeconomically, my main concern is that the last two numbers we had, both for WPI and CPI, were up rather than down, with, in one case, were a significant leap. And also, when I look at the yield curve, in other words, I look at the 3-month Treasury bills, I look at the 2, the 5, and the 10-year government bonds, the yield curve is actually inverted. In other words, the short end is slightly higher than the long end. Not a great deal. We're talking about very few basis points, but at the very least it's flat. Now, an inverted to a flat yield curve simply points out to a tight monetary policy, which strictly speaking it should be the case while inflation is not down and out yet, and that cannot be terribly supportive for the stock market, despite the fact that the stock market, as I've been indicating, has been doing quite well. The Sensex, taken together with 3 other indexes, the Thai, the Indonesian, and the Filipino index, still are amongst the 4 top performing markets in Asia. So in comparative terms, if I was to take India with the other 3 little ones, if I had put my money in the 4 of them, I would be making anything from 10 to 20%, that's the case of Indonesia, year to date in US dollar terms. Very strong performance. But I would not pile up into the Sensex right now, given that we only have perhaps another 10 days till we have the election results, and then at least we will know where the policy will be going or not going in any case. But I have a funny feeling that the election results are going to be a dumb squid. In other words, the Sensex is hardly likely to move, unless, of course, we have something totally counterintuitive. Let's say the Congress wins with a huge majority, which on the basis of the current opinion polls is very, very unlikely.